In this video, we're going to talk about Senseonics, trading under the ticker symbol SENS. At the moment, there's a lot of volatilities coming out of the stock market, and it's very important to stay up to date with the latest price movements. In today's video, I will be covering the technical aspects and how the stock performed over the recent trading sessions to identify what should be our overall approach with the stock. Before the video begins, a quick heads up that my videos are based on the trading sessions already completed and not ongoing, and not all my videos are recorded on the same day they're posted. If there are material events happening afterwards, I will make up follow-up videos to reflect those changes. With that being said, let's begin with today's topic. Senseonics is a medical startup developing devices monitoring the glucose level for people. They already have a line of products and allow patients to monitor their status in a timely manner. Their devices connect to phone applications as well, so they're quite flexible and convenient for the clients. One of the key reasons why we're here talking about it and why it was very successful in the past was because the company was chosen by ARK Invest as one of the potential disruptors of the future and invested massively into it. Things have moved on somewhat from this point since then, and nowadays Senseonics is facing the same challenges and the issues that this new phase of the market is providing. So we have seen Senseonics going through a lot of volatilities over the past few days since the stock initially received some excellent news from the regulators, with the market expecting the value of the company to be reflecting that information. But very quickly, we saw that the shareholders decided to sell the news and eventually put the stock under a tremendous amount of selling pressure, all the way to the support that has been tested twice or even more over a fairly long period of time. The decline on Wednesday and Thursday have been so significant that at some point we have the reason to believe that it may fall as low as $1.50 or back to the penny stock territories in the short to medium term. Looking over a period of 5 years, Senseonics is now sitting right above a support line of $1.80, and because it's located at a decent price level based on the price actions of the past 5 years, I think that the market may find enough motivation to keep the correction going. The other element to keep in mind is that people are relatively reluctant at giving money to the sector in general. Combined with the potential cash flow issues of startups like Senseonics, all these elements may push the stock lower still. The trading volume of Senseonics has recently been 24 million shares versus the average volume of 21 million shares. Over the previous 52-week period, its price fluctuated between $1.62 and $4.97. The market cap of Senseonics is currently at $838 million versus an enterprise value of $1.9 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market wants to allocate to the company based on the company's own fundamentals, leverage, and asset composition. A typical example is the impact by leverage. If the company has a lot of debt, the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn negatively impacts its profitability, attractiveness, or even solvency. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that the company can generate more profit or grow faster, partially because it's assumed that they have a good management team, a stronger brand recognition, or more online followers. It's basically what is unique about one company compared to an alternative competitor. So it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, as the market cap is lower than the enterprise value since the enterprise value includes the value given to the goodwill. But if the company goes to liquidation, there won't be any goodwill left. The shareholders and the bondholders would be left to distribute what's left on the balance sheet. In comparison to its historical price fluctuations, the stock is 2% higher than the 1-month low, 2% higher than the 3-month low, and 16% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment on where the stock price is likely going to head toward, The implied volatility is 131% compared to a historical volatility of 150%. The put-call volume ratio is currently at 0.43. It's normal for most stocks to have a higher put option volume than what they truly deserve, because on a systematic basis, institutional buyers would choose to hedge their exposures with put options. The most recent volume of options traded has been 30,000 contracts in a day, compared to the 30-day average volume of 22,000. Regarding the open interest, the most recent volume of open interest has been 467,000 contracts versus the 30-day average of 369,000 contracts. In terms of its shareholder structure, institutional shareholders own 29% of the outstanding shares. The biggest shareholders include BlackRock, Vanguard, and State Street. Understanding shareholder structure is relevant to an extent because it helps to determine if you should be holding the stock long-term or to view it simply as a trade opportunity. If the stock is mainly held by retail traders, then this can potentially be a sign that the stock lacks the depth to justify long-term holding. Usually, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as an investment and not just a trade. This is obviously subject to a lot of exceptions, since great companies can also be held mostly by retails and not institutional people. But that tends to be the exception for the moment and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit should the stock price fall lower. Sometimes there is significant short interest in the total volume, and this can be a sign that there is an organized shorting operation going on. The current short interest is actually quite high at 25% of the total float, 25%, and 29% of the dark pool transactions. So we really have to take consideration of all the 25% of the shorting going on, as this can also weigh on the stock price, but this can also bounce back if those people choose to recover their positions. Now, let's also take a look at the indicators. Oscillators are showing 2 sell, 8 neutral, and 1 buy, with an overall tendency of sell. The moving averages of the past price actions show 13 sell, 1 neutral, and 1 buy, with an overall tendency of strong sell. Now remember, indicators show the present and the past, but rarely predicts accurately the future. But I think that they're still relevant to an extent to determine the timing of the trade. My opinion about Senseonics is that it's a decent company, fundamentally speaking, to put in your portfolio, but the question is simply whether now is the right price and the right moment to buy in. I believe that we have to look at the stock from a longer time frame at this point, and as a result, also structure our trade so that it'll keep the balance of other positions in your portfolio. If your portfolio is sufficiently diversified, this can be a good time to enter in Senseonics now. Otherwise, I would recommend to observe the price actions of the stock closely and to prepare to enter when we see a support forming over about 1 or 2 weeks or even longer. The maximum exposure for Senseonics should be around 1 to 3% of your portfolio, with the profit targets between $3 and $4 for the time being. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon, because the financial sector would see its profit margins reduced, and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.